Chapter 12 is partnerships. Counting 1, we went through proprietorships. We talked about one owner entities, businesses that just had one owner. Now we're going to talk about, in 12, we're talking about partnerships. In 13, we're talking about corporations. So partnerships can have 2 or more. Partnerships could have 100 partners. That'd be kind of a mess, but it could happen. Whereas a proprietorship just has 1. Okay, a corporation could just have 1 owner, but they could also have thousands, tens of thousands of owners in a corporation in the form of shares. So we start out this chapter talking about the forms of businesses, just to compare them and to show you basically the life cycle of a business. Most of them start out as proprietorships. One owner, somebody with an idea, and they start to build their business. So proprietorship has pass-through taxation. That is a benefit of proprietorships. That's pass-through taxation is a good thing. What that means is that the business's income, profit, is not taxed at the business level. It's only taxed on the individual's tax return. That's a good thing. You can see that partnerships also have pass-through taxation, which is where the partners, the profits are split up between the partners, and then the partners report that on their personal income tax return. So it's taxed at their level, their percentage tax rate. Corporations, which I don't have on here, have a double taxation, meaning that they are taxed twice. They are taxed once at the business level, which is sometimes 30%, and then what's left over goes to the owners in the form of dividends, and they're taxed again at their personal tax rate. Could be as low as 10%, but starting in 2013, it could be as high as 39%. Okay, if you make over $400,000. So that really stinks, because double taxation, you're getting hit twice. When we do the corporation chapter, I'll break it down for you and show you how different and how drastic that can be for owners of the companies.
So if you've got a small business, you're not making that much money, that's a cheaper way of going through your taxes. But if you got a bigger business that makes more money, over $400,000, then you're going to pay taxes.
Well, it doesn't really matter about the size of as much money that you're making. The reason that you would go from a proprietorship to a partnership to a corporation would be the raising capital. Okay, the ability to raise capital. With one owner, you can only put so much in from yourself. Okay, if I started a business and I needed $200,000, I could probably go to the bank, have a really good business plan, have projected financial statements, and they'd probably loan me $200,000. I could probably even put my house, as collateral. This was my dream, okay, my project, my business. Now, if I started a business and I needed let's say $2 million, I probably couldn't get that from the bank. But if I had 5 people to go in with me, I might could get it. Maybe someone invested their own cash. Another person borrowed some money to put into it. Another person invested equipment. Okay, I could get partners and I could get $2 million, whereas I couldn't go to the bank to get $2 million personally by myself. Okay? All right, what if I needed $100 million? Okay, I needed to build a plant, or I'm trying to build a rocket or something. I've built my business up to where we want to expand. Maybe we want to build, expand into Canada or Mexico, or maybe we wanted to just build new factories in the United States. Okay, we need $100 million. How are we going to get that? I can't get enough partners for that, but I could put it on the stock exchange and be publicly traded and be a corporation. So the life cycle of a business, as we go from proprietorship, partnership to corporation, is basically the ability to raise capital. Okay, you would want to stay a proprietorship as long as you could, even if you made $1 million that year, because of the pass-through taxation. But if you needed to expand, build your business, buy a certain resource that was a lot that you didn't have that much capital, then you would need to bring in more people. Okay. The third one I have listed on here is limited liability corporation, and that's basically a hybrid between a partnership and a corporation. It has benefits of partnership and benefits of the corporation, but it's got pass-through taxation as well. So an LLC is, well, let me get over here. Okay, well, you hear the term LLC, limited liability corporation, limited liability company. This could be, actually could only be one person, but you have this limited liability, meaning that the owner is only responsible for the business, or the owner is only responsible for their investment. Okay, the business assets, the business worth is a separate entity. If you look at partnership, you have unlimited liability. This is bad, okay? And this is good, pass-through taxation. Just talked about that.
Well, limited, it means they can take stuff from the business, but they can't take stuff from the person. In other words, can't take their personal home.
Right, that's what limited means. Unlimited means that if Amanda and I went into a business together, we started a cupcake shop, all right, and we're partners. We just have the partnership status. We're not an LLC. If someone comes into our shop with their grandma, and the grandma eats one of our cupcakes and it poisons her and she's in the hospital for a month, or, you know, God forbid she died or something, you know, they could sue us, and all of our cupcake equipment, all of our shop, our own homes, our own cars, our own land, our own checking account, you know, things that we have in our personal life, okay, because it's unlimited. Okay, same thing with proprietorship. If I was the only owner of the cupcake shop, I'm very vulnerable to, you know, a lawsuit like that could take my personal assets. Now, LLC has this limited liability, and only the business assets could be taken. So with an LLC, you're protected. So we go to court about the food poisoning incident, and we lose, and we lose all of our equipment and our store, but that's it. We get to keep our personal home, our personal car, our personal checking account.
That's for LLC.
What's that?
That's for LLC.
LLC. Mm-hmm. Yep, you're protected here. Okay. Okay, LLC also has pass-through taxation. So we said that's a good thing. If we went a step further to the corporation status, we'd have double taxation. A corporation also has limited liability, which is good. So if you can be an LLC, that's good because you have both of these benefits of that organization. Now, the only drawback with an LLC is there's a limited number of partners, and I believe it's 75. So you can only have 75 partners. So if we go back to the example about needing, what do we say, $100 million, 75 people may not be able to round that much money up. So we may need to go into the corporation status. But LLCs are, they're not on the stock exchange. Okay, they're privately held, but you can bring in partners word of mouth. You can recruit, partners, I guess you could say, but only up to a certain amount. And I believe it's 75. It may be 100, but it's no more than 100. All right, so in chapter 13, we'll talk about corporations. We'll come back to this and kind of go back through it. Start with proprietorship, partnership. LLC is usually a middle ground between partnership and corporation, and then into the corporation status. Mutual agency, I didn't mention that one. That's basically like a marriage. That's what I like to call that. You are responsible for actions of your partner in a partnership. So this is like you're married. Okay, if your spouse goes out and runs up a credit card for $12,000, You're basically liable for it too. You're responsible for their actions, and that can be a bad thing. Okay, so we usually consider that bad because you can't control what a partner does, especially if you had 15 different partners. Your business is responsible. That partner can go out and sign a debt in the business name. They're an owner of it. So, the business is at risk if they do something that's irresponsible. Okay, so mutual agency just means that everybody's responsible for everybody else's actions. Okay, any other questions about these forms of ownership? In this chapter, when we say partnership, it's the same accounting as if we were an LLC. Okay, so this is the same, these would all be the same entries, the same steps that we would go through for partnership or LLC. Same type of accounting. All right, so the very beginning of a partnership would be forming the partnership. We would need 2 or more people, and they would need to contribute something. They would either need to contribute cash, property, or maybe even just intellectual property. They know how to do something. So they may not have the cash, but they know how to operate a machine that is needed in the business, or they have a creative mind. They have ideas. And if you agree to let them into the business without giving any cash or equipment, that's fine. It's an agreement. So each partner's investment is recorded separately. That's very important. We've got to keep everything separate because each partner has their own capital account. So we have one capital account with proprietorships in accounting 1. We can have 2, 3, 4, 5, however many partners each have a capital account with accounting for partnerships. Assets are,
Is that, so when you're looking at possibly dissolving that in the end, you're able to keep track and say, okay, this
Absolutely, yeah.
person gets this person,
Yes.
after all the other, things are paid off.
Mhm.
That's what it looks like.
Right, because you can't keep it all in one, even if you said it's 50-50. Because partners contribute stuff along the way, through the life of the partnership, and they withdraw. They take out money from the partnership. So throughout the life of it, there's increases and decreases, and you can't separate them unless you keep them separate like that. And you'll see, as we do these entries, you'll see how that works out. When we do these journal entries, just a basic journal entry, we debit the assets that are contributed, and we credit the liabilities that are contributed. Because a partner could give a building, but it has a mortgage on it. So the partnership assumes the mortgage and gets the property. So they could also contribute liabilities, okay?
Also,
And then-
if a partner left the firm, then, they could see what he donated to it or whatever, figure out what he'd get back.
Right, and we do that at the end of this chapter. All right, do y'all remember the term plug, the plug number? We did that a few times. Just go ahead and get used to it, because the word plug means you just put it in the journal entry to make it balance. Okay, so you're going to have debits and credits in your journal entry. And then at the bottom, you'll have capital, and you'll plug in whatever makes that balance. It's basically the net of assets and liabilities. These are all, the debit increases assets, the credit increases liabilities. Okay, so the books of the partnership have increases assets, increases the liabilities, but we take the difference of those two, and that's their capital balance. We plug in, I think, every chapter that we do journal entries in accounting too. So when I say plug, just know what that means. Know that that means to just put it in to make it balance. Okay, to make the entry balance. All right, let's do one of these. Joseph and Earl combining their businesses to form J&E Hardware. So they each have separate hardware businesses, and they're coming together and putting all their assets, liabilities together to form a partnership. Joseph contributes the following: $7,200 in cash, $16,300 in accounts receivable. Okay, remember he has his own business, so people owe him money. And this is, remember, that's an asset. So that's, he's giving that to the new partnership. $28,700 in inventory. What's FMV? Y'all remember that? FMV, that inventory. Fair market value. Fair market value. We always record assets at their fair market value. This inventory is worth today $28,700. On Joseph's books in his existing partnership, what's that recorded at? Is it going to be probably less than that because it's at its cost? Okay, remember the cost concept says that we record our equipment or inventory at what we purchased it for. Okay, and then we have that accumulated depreciation to deduct it out over the life of the asset, not for inventory but for equipment. So we always have to record at fair market value when we record a fixed asset or, well, actually any asset. Okay, you'll see that for accounts receivable too. Okay, he has $16,000 owed to him, but how much is actually going to be collected? What's that really worth to the new business? Okay, so always at its current value. $5,400 in store equipment. We're assuming that's fair market value. $2,500 office equipment. Again, assuming fair market value. $1,500 allowance for doubtful accounts. What does that relate to? Which of those other items? The allowance for doubtful accounts?
Accounts receivable.
Receivable, okay. So what that means is that $1,500 is expected not to be collected. Okay, that was our bad debt chapter. So of the $16,300, $1,500 probably won't be collected. So we're going to need to account for that as well. $2,600 in accounts payable. All right. Earl, he's contributing $5,100 cash, $10,000 AR, $15,000 inventory, $1,750 supplies, $900 allowance, $4,100 for accounts payable. All right, so let's do these journal entries. Okay, so remember we do them separately. So we're going to do Joseph first. We don't have a date. We'll just put January 1st. Okay, we're going to list all his assets as debits, all liabilities as credits, plug in the difference to capital. So, cash, $7,200. Accounts receivable is $16,300. Inventory is $2,800 or $28,700. Store equipment is $5,400. Office equipment $2,500. Okay, allowance for doubtful accounts. Which side does that go on? Do y'all remember the name of the allowance? Yeah, credit. Okay, so allowance for doubtful accounts, or we also call that allowance for bad debts. It's $1,500. And then accounts payable $2,600. Okay. So we need to add up the debits. 16.3.
Credits and unbid account.
Okay, so on the debit side, I got 60,100. On this side, I got 4,100. Okay, so the difference of that is 56,000. Okay, so Joseph Capital. Okay, so this is a plug. We're not told that anywhere in the problem. We just know that's the difference. Okay, if you think of the assets being the good stuff that he contributed, the credits being the bad stuff that he contributed, the debt or the bad accounts receivable, okay, or the potentially bad accounts receivable. All right, any questions on that one? Next, we need to do Earl. Is it Earl? Yeah. We need to do his contributions. All right, so we start with the assets. We got cash, 5,100. Accounts receivable, 10,000. Inventory, 15. Supplies, 1,750. Allowance, 900. And accounts payable, 4,100. Okay, add up the debits. We get 31,850. Subtract off the credits. We get 26,850 as a plug. 26,850. Okay, any questions on that one? Yes.
Why is allowance for doubtful accounts credited? Because isn't that like a cushion thing, so that they kind of think ahead?
Yes, you have to, it's a credit, it's a contra asset account. It relates to the accounts receivable, but on the balance sheet, we subtract it out. That's why it's a credit. Because it actually goes against that 10,000. Because we're saying 10,000 is owed to us, and that's an asset that we count on our balance sheet. However, 900 has been deemed potentially uncollectible. Okay, so we have to subtract that out, because if not, our balance sheet would say 10,000, and that's basically overstated, because everybody's not going to pay you. It's just a fact of life. So our balance sheet would actually have a net realizable value of 9,100 for accounts receivable. We state them separately because we could get that 900, but accounting principles say that we have to estimate that. Okay, it's similar to kind of similar to how we do depreciation. We'll have the equipment, say $5,400 for store equipment, and then we'll accumulate it. We'll do the depreciation under it as accumulated throughout the life of it. Keep it separate, okay? Because we're going to have to know that number when we sell it, basically.
So if you received the full 10,000, you would debit the account, doubtful account?
If you received what now?
If you received the full 10,000.
Full 10,000, okay. Yeah, you would, remember the allowance method, we estimated it at the end of every period. We estimated it based on percentage of sales or number of days past due. We did that, it was called an aging, accounts receivable aging. So that 900 is tweaked every period because of either what our sales were or how many people are past due. So like the AR aging had like this number were 30 days past due, this number was 60 days, this number was 120 days, whatever, 90 days. And then we said, okay, of the people that are 90 days past due, their likelihood of paying is 30%. So we multiply that by 30, add them all up. Okay, remember that?
Yeah.
So that's where that 900 comes from. That's how we got that number. The other method was the percentage of sales. We could say, historically, we don't get 10% of sales. We don't collect 10% of credit sales. And that's where that number came from. Okay? So it's tweaked at the end of every period. And then, yes, if you do collect it, you take it out of allowance and take it out of accounts receivable, too. Okay? That's starting to ring some bells. Okay, other questions? All right. At this point, we could do a balance sheet for this business for day one of J&E Hardware. We would list our cash, which would total $12,300. Okay, both the cash amounts. We would do accounts receivable, total $26,300. We'd have allowance for doubtful accounts, $2,400. We'd list store equipment, $5,400. Office equipment, $2,500. Actually, inventory would have been up there at the top of our balance sheet. For what is that? $43,700. And supplies, $1,750. Okay, we could do a balance sheet for this. We would have on the right side, we would have the debt, accounts payable would be $6,700. And then we would have Joseph Capital, $56,000, Earl Capital, $26,800. And our balance sheet would balance. Okay? So we could do a balance sheet as of day one for this business.
So when you do this on the balance sheet, do you, let's say, when they added like inventory, they both put in inventory, you put inventory, Joseph's inventory, and then
No.
or just put inventory.
It's the same account. The only thing you keep separate is their capital
So the
and their
balance sheet
drawing.
will be the combination of all together.
Right. Yep, because they're putting, Joseph put his $7,200 into the partnership bank account, and Earl put his $5,100 into the partnership bank account. So their bank account balance is $12,000, $1,300. Okay.
So we keep separate journal entries for each person, but as a report, it's a report of the company, which is everything combined.
Right. The reason we keep them separate is because of what I just circled there. Because we had to plug in that number. If we put it all together, we wouldn't know who contributed what, so we couldn't plug it in appropriately. Okay, we wouldn't know that $56,000 went to Joseph unless we did it, on the side or whatever. So you might as well just do it separate accounts. I mean, this all in the same journal. So. All right, everybody good on creating or forming a partnership? This is with 2 partners. You would do the same thing if you had 10. Okay, all separate. Okay, so once the partnership is actually earning money, the partners are going to want to get paid, right? So we need to divide the income among the partners. Now, this can be any agreement. This can be anything that they agreed on. It can be 50-50, 60-40, 80-20, whatever percentages they agreed on when they formed the partnership. That would be in their partnership agreement.
That's where, let's say the one person, Earl, for example, just wanted to be a silent partner and not really be part of the business, just contributing. Maybe he might get a lesser amount, and they would agree to that, because the other person, Joseph, might be the active person involved and stuff.
Yep. that would be exactly why. You know, or we could go back to their investments and divide it out and say a total of, what is that, 82,000 was contributed, if you add up both their capitals, and then say, okay, 56, that's more than half of the 82, so we could give him that percentage. It's whatever they agree on. But it could be because either one person is contributing intellectual, the ideas for the business or something like that. We can have salary allowances, which could be part of that. If, let's say one partner is going to be their full-time job to run the partnership, and the other one is just there as, like I said, a silent partner. Then one can get a salary allowance and the other not. Okay, a salary allowance is basically a guaranteed payment. It's the same thing as like a guaranteed payment. So we may need to account for that. That's something that they would get every month, maybe, or maybe weekly, just whatever they agree on. But it is a reduction in their capital. Okay, it's like a drawing. We would put that down as drawing because partners are not employees. So partners only get money if the partnership makes money. So it's not like your employees getting paid wages, even if you have a loss. You still have wages to pay. It's not like that. They have to make money to get money. So partners are not employees.
So you're saying if you're a partner and you draw a salary and your salary eventually goes over what was you initially put in, the place goes down. I mean, they liquidate it. Do you get any assets back?
No, you may actually have to contribute more to pay off the debts of the partnership, if that's the case. I ran into this a lot when, y'all know I do taxes from home, and I have several partnerships, and in their books, they account for that as wages when they pay their owners, their partners, their guaranteed payment. In QuickBooks, whatever they use, they write a check and they code it to wages expense. So it shows up on what financial statement? Wages expense. Income? Yeah, expenses in the income statement. So when you have wages expense, let's say $12,000, the partner gets $1,000 a month, their net income shows as $12,000 less than it really is. Because wages expense is only for employees. Where that $12,000 should be is coming out of their capital. Because the net income goes to the capital, and then we take out drawing out of the capital. So y'all remember that from chapter 4, where we close out accounts, everything goes to equity, and then you take out the drawing. So if they were to show that income statement to the bank, say they were trying to get credit, get a loan or something, and the bank looked at that, they would think that they were making $12,000 less than they actually did, because that $12,000 should actually come out of the net worth, the equity of the partnership. So you've got to make sure to account for that correctly, because it can really screw up your numbers. So salary allowances are basically a withdrawal. Okay, we're going to account for that with the drawing account. All right, another thing that could be part of their partnership agreement would be interest on their capital investment. This is basically an incentive to keep money in the partnership. So if we looked back at Joseph and Earl, Joseph has contributed $56,000, Earl $26,000. They could put in their partnership agreement that at the end, when they have their net income, they're going to divide it out. They're going to give interest based on those balances. So let's say 10%. Well, Joseph would get $5,600 of the net income for that, and Earl would get $2,685 for that part of the agreement. This is an incentive to keep money in the business and not withdraw it out. Okay, to keep capital in the business. And also it's a way for them to get a return on their investment. Because if Joseph would have put that $56,000 somewhere else, and let's say he doesn't get a salary allowance, let's just say he puts that $56,000 in a CD or, well, let's not say CD because that'd be like less than 1%. Let's say in the stock market, in some aggressive stocks, and the stock market does good, he could have gotten 10% on that. If the partnership isn't making a whole lot of money, he can still get his 10%, at least off the top of whatever income they did have. So it's an incentive, because if not, Joseph may say, I'm taking my $56,000, I'm going to put it in the stock market. I'm going to put it somewhere where I can actually get something. So it's an incentive to keep it in the business. That's not a required part. Okay, it's just if they agree on it when they create the partnership. Okay, that's not something that has to be part of the partnership. Okay, and then the remaining net income is split according to the partnership agreement. That would be, like I said, 50-50, 60-40, whatever they want to, 80-20, okay, whatever they agree on. Okay, if we had 3 partners, it could be 20-20-60. Okay, it's just whatever they agree on. One thing I'll show you here while we're talking about this, in the book, and actually on your case study, they give you things like their ratio is 1-to-1. Okay, how do you figure out what percent that is? Well, that's actually 50-50. Okay, the way you figure that out is you take 1 and divide it by the total, and you take the other number and divide it by the total, so you get 50-50. Okay, if you said 3-2, you would take 3 divided by 5 and 2 divided by 5. That would be your percentage. Those would be your percentages. Okay, it could be 1-to-1-to-2. If you had 3 partners, you just take 1 divided by the total, 4. Second partner get 1 out of 4, and the third we get 2 out of 4. Does that make sense? Hey, that confuses a lot of students sometimes, because that's something we hadn't seen in a while, if ever. Okay, so you just take the one number and divide it by the total. That gives you the percentages. Okay, so let's divide some income. This is a different partnership. Jennifer and Crystal. They had $150,000 net income. Now remember, this is after all expenses. This is from their income statement. Alright, this is their revenue minus utilities, rent, wages to their employees, not to them, but their employees, depreciation, everything, okay, down to their net income on their income statement was $150,000. Their partnership agreement has the following provisions. Jennifer gets a salary allowance of $5,000 per month. Crystal gets a salary allowance of $4,000 per month. Each partner gets 12% interest on their capital balances, and we're given their balances here. And the remaining income is split 60-40. And we can assume that 60 is for Jennifer, 40 is for Crystal, because that's the way they're listed. Okay, Jennifer's listed first. So 60 for Jennifer, 40 for Crystal. Okay, the best way to do this is just to make a little chart. Split it up. So we've got Jennifer, Crystal, and we've got salary, allowance, we've got interest on capital, we got the remaining, which is 60-40. Okay, so I've got salary allowance, got a row for that. Interest on capital, row for that, which was 12%. The remaining will be split 60-40, and then their total both should add up to be 150,000, okay? Both of those added up to equal 150,000. Okay, so Jennifer receives 5,000 per month. So that's 60,000 for the year. And Crystal gets 4,000 per month, which is 48,000 for the year. Okay, so of the 150 net income, Jennifer gets 60, Crystal gets 48. They get different amounts, maybe because Jennifer works longer hours or whatever. They figured that out when they created the partnership. Okay, the interest on their capital, we're just going to take 12%. Jennifer has 160,000. 12% of that is 19,200. Crystal's capital balance is 120,000. 12% of that is 14,400. Now next year, they still get 12%, but if Jennifer contributes more to the partnership, gives more to the partnership, she'll get more on her investment. She'll have a higher investment and get more. So it's like I said, it's a benefit for them to invest or keep their money and not withdraw it. The remaining is split 60-40. So what remains of the 150? We'll just
You add all that up and whatever's left is their money.
right. Just take the 150, subtract out 60, subtract out 48, subtract out 19,200, subtract out 14,400. Okay, we've got 8,400 left. Okay, 8,400 left. 60% of that to Jennifer. $40% of that to Crystal. Okay, if we add up all 6 of those numbers, we get 150. Let's go ahead and that's a way to check yourself. Get totals for each of them. Plus. Okay, so Jennifer is going to get 84,240. Crystal gets 65,760. Okay, so we couldn't take that 150 and just split it 60-40. So we've got other provisions to account for.
So that says if that company liquidated right now, on all assets, so that's what they would get back.
Well, Jennifer would actually get the 84,240
Right.
plus her 160.
Plus the 160.
Yeah. And Crystal would get the 65 plus the 120. This adds to that.
Now, what if the company wasn't worth that much? In other words, it had more liabilities than assets when they liquidated it, so they would get that 60-40 would be the split of what
They would have
get.
negative equity.
Yeah.
And they would have to, in order to liquidate the partnership, they would have to come up with personal cash to put toward the business.
Oh, okay.
So they would, because there would be bills unpaid.
Right.
And basically, they have unlimited liability. So they're going to have to come up with their own money to pay for it. And we can actually see that when we do some of these liquidations. Some people have enough equity to clear and get money back, but some people may not have they may have withdrawn so much that they actually have negative equity and have to contribute to make them close, to make the books close.
Now, in this scenario here, would the person maybe keep the salary for, their own personal bills and stuff and take the other stuff and reinvest it into the company?
They could, yeah. Oh yeah. The salary, especially this is their only job, they got to have money every month,
Right.
So yeah, they certainly could do that, or they could put it back into the business.
Or they say, hey, I was able to work at 40,000, I'll take the other 20 plus the rest of them and just reinvest it back
Right.
into the,
Yeah, they could.
they can do something with that.
Sure. Let me show you the next step of this. It'll kind of pull it all together for you. Closing entries. Y'all remember that? Chapter 4. We close revenues, expenses to the income summary account. We close income summary to capital. All right. This 150 represents net income. That's the balance of income summary. So what this graph, this chart has helped us do is to figure out which capital account gets what amount of that 150. So when we close out income summary, okay, we've already done revenues, expenses, and we get the balance of 150. We close out income summary, make it 0, and we're going to give Jennifer her capital account gets 84,240, and Crystal capital gets 65,760. Okay, this is basically closing entry number 3. Okay, we've already done 1 and 2 to get the 150. We weren't given the information of how much it was, but we know the net income was 150. Okay, so that's all we need for that. And then each partner gets that much. Now, let's assume that Jennifer and Crystal both took out their entire salary allowance. They're 60 and 48.
That'd be a draw, wouldn't it?
Yep, we account for that as drawing. Remember I said that a while ago. This is assuming that they took the entire salary allowance. Whoops, not Jennifer, Crystal. Took the entire salary allowance that they were due. Okay, if they did not, we wouldn't take out the whole amount. So like you said, if they took 40 and left the other 8, we would just deduct 40 from Crystal. And her capital would get the other 8. Okay, it would basically just stay in the business. What happened every month when they got their salary allowance? The journal entry, let's just say at the end of January. Okay, 2013. It would be, let's just do Jennifer. Jennifer drawing for, what was it, 5,000 and cash. Wrote her a check. Okay, this happened 12 more times. So her drawing balance is 60,000. So we're clearing that out now. Okay, so this is what happened during the year. Okay, these are the closing entries that we do now. Okay, we're closing out whatever they withdrew in the form of their salary allowance.
So that's where she's figuring out the total assets for tax purposes and all that. That's what that.
Yes, they're going to be taxed on that drawing, that withdrawal. So that would be a guaranteed payment basically, and that would go on their. It's called a K1, which the partnership does their return and then does 2 K1s for 2 partners, and that's reported on that. That goes on their tax return. Do you have a question? You stretching?
Oh, shit.
Okay. Okay, so let's just look at Jennifer for a minute. She started out with $160,000 in her capital balance. That was just from what she accumulated up to the beginning of this year. She had $160,000.
What are the taxes for?
I'm just saying we did it that many more times. We did it 12 times. The same entry we did 12 more times. So our total drawing was 60,000. We did 5,000 a month. All right, so she started out with she began 160. We add her net income, which was 84,240. We subtract her drawing, which was 60. Okay, and that's going to give us 184. Okay, yeah, what does that look like? What statement does that look like? Beginning plus net
Owner's
income?
equity.
Right, okay. So this would basically be her equity balance, her capital balance at the end of the year. She started with 160, ended up with 184. Okay, she got 84 of the income, but she had withdrawal of her salary allowance of 60. Okay, so this was for Jennifer. Crystal began with 120 plus net income of 65, 760 minus drawing of 48. Minus 48. 137, 760. Okay, you can see how if they did not withdraw their salary allowance, then they have a lot more capital. They leave it in the business. We still give it to them in net income, and then if they withdraw it, we count it out of drawing.
If they withdraw it.
If they withdraw it, if they actually get a check. They may have another job that pays their bills every month, and just leave it in the business. But we're assuming here that they got the check every month. And really, the partnerships that I'm involved with, they don't necessarily get their whole $5,000 a month. It depends on how the partnership did. I mean, if there's not $5,000 in the bank, you can't pay it to yourself. But they could get it maybe the next month. Maybe they can get like $7,000 and make up for some of that. So, it's especially if it's a small partnership, you don't know, or you might not have enough to pay both the partners for that month.
I know I've done one where we brought that a candy store and we divvied it up. I was getting 30, he got 50, and 20% went back into the business, and that's how we divvied it up.
Yeah.
Every month.
Mm-hmm.
That 20 was to pay the taxes,
Mhm.
expanded if you could.
Yeah. Okay, any questions on division of income? Okay, salary allowance, interest, split the remaining. Okay, next we've got the last part of the chapter, which is partnership admission and withdrawal, and then liquidation. Okay, so this is the life cycle of the partnership. We started with admission or creation of the partnership, then we divided the income, which we do that every year or every month possibly, and then the partnership admission could happen if you brought on a new partner. Okay, so we could add a partner. A new partner may enter the partnership by either purchasing an interest from an existing partner, basically taking their place, or by contributing assets, or both, a combination of the two. The assets must be reevaluated each time a new partner is admitted. This is all assets, not just the ones that they contribute. The reason we have to do that is because some assets may have gone up in value or gone down in value, and we need to update the capital accounts of the existing partners first before we put in a new person.
So, like, let's say it's a construction business. I become a new partner, I buy new dump trucks for the business, 10 new dump trucks. They had 5-year-old dump trucks, they were old, worn out, so my investment would be, you do depreciation on those.
Right, depreciation.
And you have mine come in.
Right. Let's say that you had like a rental company, you had rental properties, and there's two partners. Now, rental properties generally go up in value. Houses, okay, generally go up in value. So if on the books, let's say they have 3 houses, and on the books they're $300,000. It's their cost. It's what they bought them for, the two partners. Now they're worth $400,000. Well, if it's a 50-50 partnership, we're going to give each of those existing partners an extra $50,000 because they have been involved during the period of increased value, if that makes any sense. We don't want the entering partner to benefit from that because they weren't part of the partnership during those years when it went up in value. So we're basically, when you enter a new partnership, a new partner, you're basically creating an entirely new partnership. So it's that's what they call limited life of a partnership. That wasn't one on our first slide, but that is another characteristic. It's got limited life, meaning that every time someone enters the partnership or someone leaves, an entirely new partnership is created. Now, a corporation like Walmart, okay, let's say one of their shareholders dies. What happens? Nothing. You know, they don't have to create a whole new corporation papers and all this stuff. You know, people die, people buy shares every day, sell shares, whatever. They become owners and they sell out. So it has unlimited life. It goes on way after the life of the founder or the life of the owners. Okay, so it continues. Partnerships have a limited life.
So if you're a lawyer and you become a partner in another firm, you'd use that. Lawyers have partnerships a lot. So.
Yeah, accounting firms.
That kind of
Yep. Okay. A lot of partnerships are husband-wife kind of thing. If it's a small business, the husband and wife are both owners. That's a mistake.
That could cause problems. Things don't go
and you know, so
ugly divorces.
you know, they say the only ship that won't sail is a partnership. That's what they say. Yeah,
I learned my lesson.
Partnerships can be bad news.
Yeah, I learned my lesson about having family as a partner. I was very good with the money. My brother wasn't. I'm in Michigan. He's here. His business is down here. Cost me $12,000, $15,000 in learning a lesson.
And can sometimes sever a relationship. But with partnerships are, that's why you want to keep them small. Because if you had 10 partners, you know, hello, you're reliable, you're responsible for all their actions. It can get kind of messy.
What are the odds of 10 people agreeing on something?
Exactly.
Actually, as an example, my wife's two brothers went into a partnership, and one brother, because he of bad dealings, the other brother was held liable, and he was actually put in prison for it.
Yeah.
Well, I could have done that with my brother, but I wouldn't want to.
Well, it's kind of like a college roommate.
Yeah.
They say don't be your best friend's roommate, right? Don't have an apartment with your best friend because you end up hating each other when it's over. And I'm proof of that. So.
Well, it's funny because when, if
literally.
the police, if they can't find the one partner, they have no alternative but to go to the other one.
They're both
because they're
liable
both liable.
Mm-hmm.
So
Yep.
there are those circumstances.
Mm-hmm. Okay, so we also could have bonuses that could be part of this, maybe given to existing partners or to the new partner. Okay, a bonus would be a situation where, okay, Amanda and I have the cupcake shop. If we go back to that example, we haven't been sued or anything, but let's just say we've got a good thing going. We're making some money. We need some more equipment, or maybe we want to open a store in another county or something like that. So we pull on Anna to be our third partner, and we give her a bonus. We say, okay, if you contribute $50,000, we'll actually give you $60,000 in capital. We'll give you $60,000 in equity. You can have 5 from me and 5 from her. We'll just give you that because we really need her. Okay, the opposite of that could be if, no, actually I said that wrong. If we have a good thing going and she wants to be a part of us, we don't need her, but she wants to be a part of us, then she could contribute 50 and we only give her 40. I probably just totally screwed that up, but y'all get the point. Okay, we could either be desperate and give her extra, or we could be not desperate. We're just going to be nice because she's our friend and she wants to be in our partnership, and say, well, we'll let you in, but we're only going to give you $40,000 of capital for your 50.
So it costs you
That would be a bonus to
$10,000.
us, to the existing partners.
Costs a loss of $10,000 just to be part of the
Right,
partnership.
but hey, we're selling some cupcakes, so we're doing good. So she wants in on this good thing. So anyhow, it could go either way.
That's a lot of
Okay.
cupcakes, $10,000 a cupcake.
Yeah. You don't watch Cupcake Wars?
Well, there's something special in them, or a little hashish or something.
It's a secret. That's why we have a secret recipe.
Special recipe.
And we're going to do examples of all these with our case study, okay? The last thing to cover rather quickly. Okay, we have a few minutes left. Just to finish up your notes, and then we'll do examples on the case study. Also, we did admitting new partner, partnership withdrawal, death of a partner. Okay, net income for the current year is divided among all partners at the date of death. Okay, so if a partner dies, then you basically your partnership ends on that day, and you divide everything out on that day.
I think the end of blanks at the top.
Okay, admitting a new partner, purchasing an interest, transfer equity amounts from existing partner to capital account of new partner.
What was your evaluation of assets?
Fair market value. Fair market value. Okay, so admitting a new partner, like I said, you can either buy it from somebody. You could buy their equity. Let's say they had $50,000 in equity, and you buy it for $60,000. I mean, the partner can set that. That $60,000 doesn't go to the partnership; it goes to their personal bank account. It's just like selling an investment, and anything else. Or you can contribute and have a third partner. Either way. Okay, so reevaluation of assets, up or down to fair market value. Okay, and then we change the equity accounts accordingly. Okay, death of a partner is date of death, so fill in the blank for that one. Okay, the balance of the deceased capital account is transferred to their estate. So whatever their balance is, it actually goes to their estate, and then that's divvied up in whatever way. Their family.
You don't have a will, a lot of states takes 50% of what the assets are before the will is being voted.
Yeah, sucks to die.
Yep.
Okay, liquidating partnerships. The last part. Liquidation is going out of business. The first thing that happens is that all the assets are sold. Supplies, inventory, equipment, land, machinery, vehicles. Okay, all the assets are sold. You can even sell accounts receivable. Okay, you can sell that too. Companies buy that, and they take on. Yeah, now they're probably not going to buy it for its face value, but you can get rid of it if you can't collect it all.
Sure.
Okay, assets are sold. When you sell assets, you usually have a gain or loss. Okay, you're very rarely just going to break even. Sell it for what your cost, or what you have in it. Okay.
Buy cheap, sell high.
So the second step is to divide the gain or loss based on income sharing ratio. That's that 50-50, 60-40. Okay, the third thing that happens is liabilities are paid. So the debts are paid with the money you got from selling the assets. And the remaining income is distributed based on capital balances. So it does not matter about the income sharing ratio at that point. Okay, that's the key part of liquidation. The gain or loss is based on the income ratio, but the remaining, what's left, the net worth, is split based on what the capital balances are. Okay, this is a statement of partnership liquidation. Maybe you can see it, it's in your book. If not, this is Farley, Green, and Hall. Look at these steps. At the very top, we've basically got their balance sheet. At the very top, we've got their assets are cash. They've got cash. Non-cash assets will be inventory, supplies, their liabilities plus their capital. Okay, so if we added up 9,000, 22, 22, 22, we would get 76,000. Okay? Or 75. Yeah, 75. All right, so the step one was to sell the assets. We sold these non-cash assets and received $72,000. Okay? We sold all these assets for $72,000. We have a gain. Okay, we have an $8,000 gain. Their income sharing ratio, 50, 30, 20. Farley gets 50% of 8,000. Green gets 30% of 8,000. Hall gets 20% of 8,000. So that step two was to divide the gain or loss, 8,000, by their income sharing ratio of 50, 30, 20. All right, so now our new balances. We've got more cash because we sold the assets. Still owe a debt, and we've got our updated capital balances. Step three is to pay the debt. So we pay cash, clear out the debt. Now we have zero debt, and we're down to $74,000 in cash. The last step is to distribute cash to the partners. We've got $74,000. Who gets what? We don't split it 50, 30, 20. We give them what they have in the business. Okay, we give them based on their capital balances. Okay, we're going to do one of those too in our case study, I believe. So, okay, any questions? Yes.
What was the blank on liquidating partnership?
As cash is realized, it's paid to creditors. Mm-hmm.